anyone that tells you they know when they're going to exit their deal is full of it, because or at least they are very willing to take a bad return because they want to sell by a certain period of time. I think the smartest investors are those that have a projected timeline, but are more than willing to wait for the right time to sell.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. Today, we're speaking with the co-founder and chief investment officer of Sentinel Net Lease. It's a privately held commercial real estate investment firm with more than $300 million under management and 1.8 million square feet of properties across a dozen states. The reason why I love today's conversation is because we're drawing from the guests more than 20 years of experience with some of the biggest investment firms and the biggest real estate development companies in the United States, doing the research, the market analysis, the growth, the actual management of this stuff. Man, I'm so excited about this conversation. Let's jump into this. Everybody, please welcome Mr. Dennis Cisterna to the show. Dennis, welcome to the show. Man, another day, another dollar, so much to talk about. Where do we even start with your vast experience? First of all, welcome to the show.
Thanks, Brad. Thanks for having me. Appreciate it.
And I always love to learn where are you calling in from today, Dennis?
I am in Cabo San Lucas for spring break,
Okay.
but still working.
Yep. You travel with your podcast mic.
I'm, sometimes you have to pack for the right situation. So I brought my golf shoes and my podcast mic. That's it.
That's awesome. That's awesome. So I learned. So I've got for the other podcasters out there, you've got your setup at home or in the office, and then when you travel, learning to find the right things. So I see that you've got your mic there. I recently invested in this little travel mic stand, so it's a lot easier to pack.
I'm gonna have to get the link for you here, because I definitely feel like a 1950s radio DJ with this thing in my luggage.
That's funny. It's so funny. But hey, this is what we're talking about. We're talking about building wealth through real estate that affords us the ability to live life by design. And if that's not it, golfing in San Lucas while still being able to share some of your expertise across the radio waves and the internet here, does it get any better than that, Dennis?
I'm a big believer in work-life balance, and I think that like a lot of your listeners, that the easiest path to get there is definitely through real estate.
Yeah, absolutely. Well, I'm excited about that. Let's jump into this. Why don't we let the listeners know just a little bit about who you are, and
Sure.
Man, how did you get to where you're at now?
Well, it's a very conventional path, actually, because I started my career in the real estate space. I started out of college as a housing market analyst, worked my way up the corporate ladder, making a bunch of other people money for 20 something years. Finally got to that, exalted CEO spot and realized that I still had a board of directors and investors, and I really didn't have the freedom or the control that I thought I did in my life. I made a good paycheck, but I was still, my whole focal point was making the company money, not myself money. And so about 5 years ago, I left that position. I started my own investment firm. I've started 2 other investment firms since then. So the first 2 were residential oriented, and then my primary focus now, Sentinel Net Lease, is commercial real estate oriented. But I think it's the same thing that a lot of people have in their life. Even if they love what they do, there might be a better way to do it. And so that for me was the jumping off point. I know there's a ton of people that have made an absolute fortune in real estate as a second career. I did pretty good in my first career working for other people, but I really found that I was able to leverage my knowledge and benefit myself directly by starting my own firm and growing my investment platform. And that's where I'm at now. And so my focal point with Sentinel is really to kind of bring Wall Street opportunities to Main Street investors. So using my 25 years of institutional background working for big companies like Lennar and Toll Brothers and Cerberus, and really going and underwriting and finding those opportunities in the market that I think are going to outperform everything else. And so I've been pretty fortunate in the single family space early on, and the build for rent sector, which is purpose built rental homes, the entire community. And then also successful with commercial real estate over the last several years. And I think right now, given where the Fed has pushed interest rates and how the commercial real estate sector has responded to that, that I've got a really excellent runway for the next couple of years to buy, really high quality properties at kind of historically low prices. And, it's not too different than, what you saw in the single family space after the recession, where you saw, deep discounting and ability to buy this generational pricing. That's kind of what's going on in commercial real estate right now. And so pretty exciting.
Yeah, I think you said it right there, to take the jump, right? Otherwise known as take the plunge, when you do leave that thing that you're comfortable doing to get into this new venture. So much I want to unpack there. Dennis, first of all, when taking the plunge, taking the jump, and you say that you start your own investment firm, your own investment company, what does that mean? Like, are you just an investor that's building a team, a company around it? What do you mean by investment firm? What's that
So
mean to you?
yeah, a lot of people are when they make the leap, it's to just go do whatever they're doing full time by themselves. But because my background is working on bigger projects and bigger deals, I didn't want to go do 2 or 3 flips. So the first thing we acquired, it's kind of a little esoteric, but we bought 30 model homes from a home builder, and we did a sale leaseback with them. And so it's kind of an off balance sheet financing solution for the home builder to help their balance sheet. We buy it at a very attractive cap rate, and then we lease it back to them because they need to use it to run the sales for their communities. And that was a $11.7 million transaction. So I certainly wasn't going to be able to fund that by myself. So what I did was, I put together an investment summary. I found a lender to fund the deal, and then I took it to, essentially my network of people I know that like my background. They know what I do, and they were looking for a good alternative to the stock market or some of the other real estate ventures they've got into. And so they invested alongside me as a limited partner. And so that's how I've kind of grown that platform. And so now between, the 3 platforms, we've got big institutional partners, but really we focus on the smaller retail investors, the mom and pop, the doctors, the dentists, the attorneys, things like that, where they don't necessarily have the full time to make that leap, but they want to get started. And so we have about 325 different investors on our platform that up until this point could just basically pick and choose what kind of deals they wanted to invest in, whether it was a residential deal, an office building, a grocery store. But with the way the market's changing now, we're really focused on, we've just launched a fund. And so the fund gives those investors kind of instant diversity because it's spreading that investment across whatever we're going to buy over the next couple of years.
And the fund then, instead of each individual investor, say a strip mall kind of scenario or a multifamily, as the LP, you're in there individually into this deal as a limited partner. But the fund allows you more of the kind of like the stock exchange approach, where you're pulling the money, and then you guys, your company, Sentinel Net Lease, is the controller of those funds directly.
That's right. Yeah. So we are the fund manager. So my team goes out there and we source the properties, we underwrite them, we put the debt financing in place, and we're ultimately the manager of all the properties. We're asset managing everything. We may have third-party property managers for some of it. And so the goal here is to be able to provide for the investor something that is generally thematic. So we're buying, office, industrial, retail, and it's all secured by long-term net leases where the most of the responsibility is that of the tenants. And they're secured by leases that are anywhere from 8 to 20 years long, right? So it's got good stability behind it. And it's usually at a cap rate that's somewhere in this environment, somewhere between 8.5% and 11%.
Oh,
And
wow.
so when you go borrow at 6.5 or 7, it produces a double-digit cash-on-cash return. And that cash-on-cash return just gets better over time as you have these contractual rent increases. So, you're having a variety of asset types spread across a number of geographies across the U.S. But it is very thematic in what you're buying, but you are getting that natural diversity between locations and asset types and tenants. So it's
Very
a good way
interesting.
to kind of be in a lot of sandboxes at once, with a relatively small investment.
The fund. The
Yeah.
fund. And I want to jump back into the residential world, but before we got there, this cap rate range that you were just talking about, that 8.5 kind of to 11, where do you find that kind of cap rate, where it's not a heavy value add scenario, you know?
In the Midwest and the Southeast mainly.
Yeah.
Um, but it all
Not big
depends. It
cities,
also, I'm sorry.
not big cities, right?
Oh no, no, definitely big cities, but usually in the suburban locations.
Okay.
And it's really a function of the size of the deals we acquire. So our average deal size is close to $20 million. And so one thing that any of your listeners will find that as they enter the commercial real estate space, the the least attractive deals are the smallest ones. So if you're going to go buy a Starbucks or a McDonald's or a CVS, um, those cap rates are awful, man. They're 4.5, 5%, even when your high yield checking account is 5%.
Yeah.
So why are you? Yeah, I've always been blown away by that. Now, most of those buyers are 1031 folks that are really just trying to protect their capital gains, and they're not caring as much about their basis. Obviously, I think that's kind of crazy. I don't really know how you actually make a buck in that environment unless you catch the right side of an interest rate trade, but that's really not an investment strategy. That's luck. Um, so for us, it's going into this upper middle market range where there's much less competition. So we're kind of at the bottom end of institutional buyers, big REITs, hedge funds, things like that, and kind of at the top level of syndication firms that will go and pool money together on an individual basis. So that area just trades wider because, frankly, they know how to assess the risk better at this level. We do. So there's not as much competition from folks that don't, and because of that, you tend to get better yields. And that was really one of the drivers behind starting the fund as well, was to have this cash on hand to give us a competitive advantage against even some of the institutional guys that require leverage. If I know I can go in there and close on something cash in this environment, certainty of execution is everything, because it's very tough to get a loan on anything right now, frankly. So if you can go into a position and you're bidding on something where you don't require a financing contingency, it's a huge benefit as a commercial real estate buyer.
Certainty of execution. How likely is it that you're going to close? That's what I want to know as a seller, right? And that's
That's
what's
right.
giving you that buying power right now. Man, that's really, really interesting. And then on that, so if your average deal is around the 20 million mark, and if that's something you do close on cash because of the fund, what does that exit look like? I'm just thinking generally, in the syndication world, we're targeting, this certain exit period to, one, I've got my cash flow, and then two, I've got that equity multiple. How does that work with the fund, and what is your general or average type of exit, or are you exiting of these
Yeah.
investments?
So I'll answer it in two pieces here. Anyone that tells you they know when they're going to exit their deal is full of it, because or at least they are very willing to take a bad return because they want to sell by a certain period of time. I think the smartest investors are those that have a projected timeline, but are more than willing to wait for the right time to sell. And so in this environment, I am not a seller at all. Why would you be? Interest rates have expanded, cap rates have expanded. However, we do get unsolicited offers on properties at times. And a good example of that is we had this massive JP Morgan Chase call center in Springfield, Missouri. We bought it for $90 a square foot. If you were going to rebuild it today, it would cost $450 a square foot. So we had a very great position. We had JP Morgan in there for when we bought it, 7 years of lease term remaining, and we got long-term fixed rate debt that was at a like 4% rate, and our cap rate on the deal was almost 8 at the time. So it was cash on cash was phenomenal. They wanted to reduce their footprint a little bit, so we took a small portion of the building out to market to lease, and a healthcare company came to us and said, "Would you consider selling the whole building?" So this was an owner user that we thought would be a potential tenant. And we said, sure. And we just threw out what we thought was a very, very reasonable number to us.
Move. Yeah.
Yeah. Make me move. That's right. Yeah. Zillow's make me move number. So they did, and they made us move. So we sold the property to them, and we had a 1.9 multiple in 23 months.
Oh, wow.
So
that's nice.
It's one of the most profitable office trades since COVID. And it wasn't even part of my business plan, right? Our business plan was to hold this. JP Morgan Chase had a 10-year renewal coming up at the end of their term. We just thought we would get them to execute on that, and then we would sell it. But, you know, this owner occupant had a different plan for our property, and so we were willing to sell. Generally speaking, we're going to, underwrite a hold period of 4 to 6 years because we think we're buying at the right basis, and we think that we can either create value through a lease extension or contractual rent increases, or if we're lucky, like some of these other folks that their primary business is, we're on the right side of an interest rate trade where cap rates compress. So my thesis today is pretty simple. We're gonna buy things and create a cash on cash that's generally, let's call it 9 to 15%. That beats the pants off of what you're going to get in multifamily and in most residential deals today. Beats industrial, it beats hotels. So we're going to clip this nice coupon. And if and when the market does move, because we've got these secured on usually a decade-long plus lease, then we'll look at selling when we think that cap rate compression has occurred, and we're just going to clip this progressively nice coupon along the same line. And so if a multifamily operator, they're banking on, rent increases that are very tough to come by because we just went through an all-time rent increase, and now households are strained on income, and they're banking on a interest rate reduction and cap rate compression to get to their IRR. Well, I feel I'm in a much better spot by having guaranteed rent increases at a much better basis at a higher cap rate. And then if the same macro event occurs where cap rates compress, well, my IRR is going to be, 30 to 50% higher than theirs at least. So that's kind of the strategy there. And at the end of it, when it comes to selling the asset, if it doesn't make sense to sell it, we're just going to hold it and continue to clip the coupon because my goal here is to generate an upper teens to low 20s IRR with really making the money on the buy.
What was the target IRR again?
18 to 22.
Nice. Very cool. And so the internal rate of return, right? And this is this measurement of basically not only how much money you're making in return, but the time related to that as well, too.
That's right.
And then the other thing we talked about, that 1.9 multiple, is the equity multiplier in this piece. So definitely some very interesting pieces when we're looking at commercial real estate. And I love it. I'm so new in all of this, but I could see like how long you've been in this, Dennis, and how much you've been through. It's so good because you're explaining it. So it's easy to follow along. So I really appreciate that. These loans, so when you do cash and you do, say, you leverage or you refi to turn these things out, what is the typical time span for the loans? I know it's going to be relative to the property, probably the dollar amount and all of that, but what are some typical loans that you're seeing in these types of investments?
Yeah, so the commercial real estate world's a little different than the resi investment side, especially like flips, right? Which are usually very high leverage and higher cost, but you're making your money on those pretty easily, so you can absorb those high interest rates because it's a short period of time. On the commercial real estate world, these are perm loans. They're typically 5 to 10 years in length. You can do fixed or floating rate. Usually we'll try to close on the property with that financing already attached to it. So we'll close with the financing in tow so we don't have to put out as much equity. But if we don't, it's the same process. It's just 60 days, 90 days later. And so the main lenders in the commercial real estate world are regional banks and credit unions, life insurance companies, and the securitized market, which is CMBS. So those are mortgage-backed securities that are basically all the real estate loans are bundled into a bond, and that bond is then sold off. Very similar to how residential mortgages are done. And so each one of those lenders has pros and cons. Right now, banks and credit unions have come under a lot of fire recently because they were very loose with the real estate lending they were doing kind of during COVID. And now they have a lot of exposure on what people would consider troubled assets. So those loans typically are now, like for an office property, 50% loan to value. For even a class A retail center or an industrial property, maybe 65% loan to value. So these are lower leverage loans in general. Really, they're, other than if you're getting bridge debt, which is like for a transitional asset that's value add, or if you're getting a construction loan, unless you're getting that, everything is kind of topping off right now at about 65% loan to value, no matter what the asset type is, other than multifamily. And so, that makes it difficult when interest rates are generally right now for the commercial real estate world, 6.5% to 7.25% is kind of the universe. And another important thing is a lot of lenders are now requiring some level of recourse. And for those of the listeners that don't know, that means there's basically a personal guarantee on the loan. I would highly recommend that you do not sign a recourse loan. I would rather you look harder. So on our deals, we will go out to, I'm not kidding you, 150 different lenders on every deal we do. And that may sound insane, but if you look at what you accomplish by doing that, you really understand where the whole market is on each deal, and you're going to get the best terms possible. There's a really cool number of cool websites out there that actually show you the banks and the location of those banks. So let's say you're in South Carolina and you want to know every bank that has a branch in South Carolina. Well, you can go to one of these lists. You can do it on the FDIC, a number of other websites. It'll show you every bank that has a branch in that state. And then you basically, if you're going to do any loan over a couple $1 million, that bank's got to have at least $500 million in deposit. So you can kind of shortlist the number of banks you're going to attack from there. And then you just start working the phones and trying to create a relationship. But the lending environment is definitely not easy for the commercial side right now.
Yeah. Yeah. And that LTV piece back in the COVID, even on the residential side, I mean, that was the first thing to crunch. I felt that. And during COVID, all of a sudden, all the lenders were like squeezing. And, the most I could get even on the residential side was like 50% or something. I'm like, what are you guys doing to me here?
Right.
Right. That's crazy.
Which is kind of crazy if you look at it, because they were willing to give you 70 or 80 or 90% before at a 2.5% to 3.25% rate. But now all of a sudden they want to charge you 6 or 7 or 8 and you're only getting half. So that just shows you exactly how much their risk tolerance has changed over that 24-month period.
Yep. Assessing risk, that's for sure. So I want to bounce back here, Dennis, into the residential world and tell us a little bit. So you came out, it sounded like your first job was in the market analysis for residential, and you've got to be in either on the lending side or the development side. You're a pretty big company if you're looking at market studies like that, and you have an employee that's strictly focused in on that. And I see one of the names on the list of companies you were with was the Toll Brothers, and they are big residential, right?
Yeah, they're one of the 10 biggest home builders in the country, as well as Lennar, who's one of the top 2.
Uh-huh.
So I started my career as a housing market analyst, and I was basically a consultant doing studies for these big builders. They would want to maybe buy 500 acres here or buy a new community of finished lots in another location. And they would want to know who's our target audience, what kind of homes should we build, how quick will they
Mm-hmm.
sell, what's the number of building permits issued, you know, you name it, the kind of diligence they want to do to understand and underwrite an opportunity, it was there. And so I went from working for this advisory firm to actually working for the developers themselves, running project management and then ultimately acquisitions for Southern California for Toll Brothers. And that was a pretty crazy time. That was right up until the Great Recession, and everybody and their mother would. This is when people were camping out for homes for 3 days. It was really the worst part of what you saw of The Big Short happening in the housing industry at that
Mm-hmm.
time.
Wow.
But it's been very interesting to be able to learn the lessons I have from that period in time, and also translate it really to what I'm doing now, so I don't make some of the mistakes that some of those developers made in the past, and also be able to translate some of that to smaller investors, whether they're single family flippers or people building a rental portfolio. I talk to a lot of investors of various sizes, and it blows my mind. One of the things that I think the average investor doesn't know is the vast majority of the information that I use for data analysis and underwriting, it's free and it's available. Most of it is government websites, to be honest with you. The Census Bureau, the Bureau of Economic Analysis, Bureau of Labor Statistics, HUD. There is so much information out there that would make you a more intelligent investor, whether you're investing in your own backyard or somebody else's backyard, that I certainly encourage folks to take a look at. It's really a very underutilized resource for what I would consider to be a growing investor.
So those websites, how difficult is it to have up-to-date information? Do some of those sites lag?
It depends on what it is, but whatever information you have is the most recent information. It's
Mhm.
other than economic groups that are making forecasts going forward. But I mean, most of it is released 30 to 60 days after the data has occurred. So it's not like it's years in the past or anything. There's certainly some level of data that lags more than others, but if you're looking like at employment statistics, um, wages, the unemployment rate, the interest rates, the building permit issuance. That's an important thing. A lot of, if you start to venture into adding new supply to an area, the first thing I always encourage people to do is either visit their local planning counter, or go to one of these websites that track the building permit issuance, because home builders don't talk to each other, and we have a tendency to oversaturate a market very quickly when times
Mhm.
are good.
Mhm.
That's kind of what Toll Brothers, along with every other builder, did when the during the recession, and so that information is available out there, and that way you kind of know what you're up against if you're going to bring new supply to a market.
Yeah. And that's the I was speaking with somebody is household start, household formation kind of
Yeah,
data that we're looking at when we're doing
yeah,
that kind of stuff.
yeah. So that helps too. So if you want to look at household formation, household growth in an area, employment growth in an area helps. I mean, employment growth is really the primary driver of housing demand. So, and you can get that down to literally a zip code level, for free. So it is pretty useful stuff, if you're going to take on something that's a little more challenging or scalable than individual flips.
Yep, yep. Um, you called it the residential versus the commercial world, and we talked, prior to going onto the recording here, that residential is a great spot to learn, get in there, and I agree with you 100% on that because I mean it's easy to it's easier to deal with mistakes that you're going to make, in that regard, and easier to get in, easier to get out. Um, but this everything's cyclical, right? Everything's on this cycle, and the idea that the residential kind of came up, plateaued, went down, circled back. I've always noticed that commercial does the same thing, and it lags behind residential. And it's interesting for me to hear you now, Dennis, saying that now we're getting to that buying point in the commercial world. So it's a great spot to be. Hey, if you're listening to this, you've got that little twinkle in your ear, finding somebody like Sentinel Net Lease, somebody to help you grow, whether it's syndications or whatever it may be, the fund. But now is a great time to start picking up and start taking action because it's a great time to buy. With that in mind, Dennis, what are some of the areas? Two questions here: areas geographically, and then two, the asset type. What type of classes are you excited about right now? Just like how excited you are to strap on your golf shoes and go golfing down there in Mexico. That same kind of excitement. Where are we at?
I'm sadly equally excited about real estate investing as much as I am about golf. So there is a pure passion for what I do.
Yeah.
And that's a great question because I think when you use conventional wisdom, you think of like the biggest cities is where the best opportunities are, right? You think of LA, Miami, New York, Chicago, and in reality, those are some of the most difficult places to make money because they're highly competitive. You're not only dealing with professional investors, you're dealing with amateur investors. You're also dealing with foreign investors in a lot of this market who have completely different return profiles. So geographically, I think there's a tremendous amount of value in the Midwest and the Southeast. Um, a lot of big hedge funds, private equity companies, they just view the entire Midwest as flyover country. And I think they're missing the quality of life and the affordability that a lot of the major cities in the Midwest bring. I mean, you look at I mean you can start kind of in Texas. Obviously, everyone knows Texas is booming, but it's not just Dallas and Austin. It's Houston has a tremendous amount of opportunities. San Antonio has been sneaky strong for the last 5 years and growing very rapidly. Tons of opportunities around the Atlanta metro area. Jacksonville is an underrated market in Florida. And then if you look, even if you just kind of meander up the Midwest, there's a number of markets: Oklahoma City, Kansas City, Omaha, like really just some cool markets that have this high quality of life, and your basis there is just so much better on what you're buying, where you're really buying quality for a fraction of what you could elsewhere. So I love those markets geographically. The Carolinas offer a lot of opportunities as well. Um, I would steer clear of kind of Louisiana, Arkansas. Those aren't quite growing quite as fast as some of the other areas in the general regions I talked about. But look, there could be a good market anywhere. I think that's what really separates great investors from bad investors from where the opportunity is if you're just going to put a red flag on an entire area without really knowing it, then that means the next guy might find the good deal that's in that market. So it's definitely worth looking in some of those less publicized metro areas in the Southeast and the Midwest. And then asset class wise, um, industrial is tough. Multifamily is near impossible to get to a level you want unless you're doing a significant amount of value add. And so I think that's where I would differentiate. There are still good value add multifamily opportunities out there if you're with an experienced operator that knows how to create the lift in rents, knows how to fully stabilize a community, and then puts the right debt in place on it. And then when the market does come around on multifamily and rates compress further, that could be a good opportunity for a pop there. I think buying stabilized multifamily right now is darn near impossible. Same thing with industrial, unless it's a really older building. And when you do that, you take on all kinds of operational issues, capital expenditure issues of repairing roofs and HVAC systems and things that are big budget busters that maybe you're not used to on the residential side of things. And then frankly, I think the best opportunity on stabilized stuff right now is in office. And I have some very spirited discussions with people here. Yeah.
That's
So
That's the first time I've heard that right now at this
It's
particular time in the market.
it's not all office, and
Right.
that is where if you're doing your homework, you realize that what happens in these markets is they throw out the baby with the bathwater constantly when a sector is out of favor.
Yep.
So in 2016, 2017, retail's bad. All of retail was bad in 2016 and 2017. And there are some guys that got absolutely incredible deals because a huge portion of the market became inactive in buying those assets. And so now, post COVID and with retail starting to embrace technology more, where now if you go to a Target is a quasi distribution center and a store, right? So
Hmm.
they can ship to you from that store. You can pick it up from the store. Instacart can go pick it up for you from the store, or you can just go in and shop. And so those retail centers have actually created a lot of different value now in how they serve a community. Um, and retail has rebounded significantly better than a number of other asset classes post COVID. So I think there's some interesting opportunities in retail, but on the office side, it's that same thing of, does office suck in general? Yes, but not all office everywhere is bad, right? And so if you can buy at a cap rate that is double what the rest of the market is at, and you're buying at a fraction of replacement cost, and you're in a good market where, excuse me, you have, a lease in place for 10 or 15 or 20 years, we're already starting to work through the office issues, right? We have millions and millions of square feet of like ugly 70s, 80s, even early 90s office vintage that is near vacant. That office supply is never really coming back to the market, so it really shouldn't be considered part of the current total supply as it is anyway. Most of those are getting knocked down. Um, in some markets, getting repurposed as residential. That's a lot harder than it's advertised.
Yeah.
But ultimately, over the next decade, the office sector is going to right size. Companies are already reducing their footprint to what they think they need today. And as those companies grow, they'll need to expand into more space. And if we take, 100 million square feet of office offline over the next 5 years, all of a sudden the market vacancy rate goes from 18% to 12%. And now we're back at the historical average. And all we did was get rid of the ugly stuff.
Hmm.
So that, I think that's where part of the opportunity is. And then as interest rates come down, whenever they come down, that market will have the same level of cap rate compression as the other markets. And so I think that's where you create some of the value. So it is a needle in a haystack approach because there is a lot of office for sale that you don't want any part of. But that's where, I take advantage of my background. We've got a great research guy on our staff, and I don't know the number. I think we've looked at like 13,000 office listings, and we've put offers out on 200 of them.
Wow. Wow. What kind of off kilter question here? What kind of database or CRM system are you using to track listings, due diligence, offers, all of that stuff?
Yeah, so the two different systems, but on the front end, kind of the sourcing of the deals, the market has created the CRM for that. So historically the most popular system is called LoopNet, and
Mm.
so LoopNet, which is owned by CoStar now, which is the biggest information database of commercial real estate properties, that's where brokers primarily used to list. It's like the MLS for commercial real estate. But over the last couple years, there's been some new competitors to the space, namely a company called Crexi, that their user interface is a little bit more nimble. They stay on top of the listings to make sure old listings aren't still up there after property's been sold. And so that's kind of on the front end to know what properties am I interested in, what am I going to bid on, um, and then kind of manage it from there. And then once we've actually got into our internal pipeline of deals that we're bidding on and tracking what that process is, we use a software called Appfolio.
Mm.
And that's actually also our investment management portal. So all of our investors log into this portal They can download all of their documents 24/7. But then in addition to that portion, and the CRM portion of both our investors and our deals, that's where we can house a lot of our databases and everything else. So we combine that with basically Microsoft Enterprise. So using OneDrive and Teams and that whole suite of services combined with AppFolio is kind of the 1-2 punch to manage everything we do.
Nice, nice. Bounce back to the market question here right quick. What are the top 3 KPIs that you look at to say, hey, I like this market?
So I will generally start with population density in an area to make sure that I like that it's a big enough market for me and it's a big enough suburban market. So I could say that, hey, I'm going to go to, Chicago, and Chicago's got 8 million people. But if I'm in the wrong area in Chicago, that doesn't have a lot of population density, then I don't feel good about the growth in that market. So I'm looking at really a combination of population density and then what that growth looks like over the next 10 years. And so that's an important 1-2 punch. I look at household incomes as another important factor in this, because we generally want to be in high quality of life areas. And as you might imagine, the higher the income, the rest of the demographics follow. So generally, if you're in an area with high incomes, you are also in an area with a higher percentage of degrees, a higher overall net worth figure. So it just, when you start with income, it starts to check off all these other boxes from a quality of life perspective. The better schools are in the areas where the higher incomes are. So that's definitely a leading KPI for us. And then ultimately, I would say the third one that we're looking at, depending on what kind of asset we're looking at, is the commute time to, and that's not really a KPI, but it's an important factor, is what are the commute times? What do those look like to the major hubs of activity in that market? So is it an hour from the airport? Is it an hour from downtown? Is it 20 minutes from the best hospital? Those kind of factor to the main commercial services and activity hubs in a market, super important to us, because that's where we see a lot of stability. If it's connected in some way to some of the major elements of whatever drives that market.
And I know this would vary from asset to asset and even area to area, but what's a household income that's kind of like the bottom line that says, hey, this has got a higher quality of life here?
What's the bottom income like number?
Yeah.
So it depends on if you use median or average, but generally, if you're looking at a median household income that's north of $100,000, regardless of where you are in the country, other than the most expensive states, that's kind of a pretty good low level number to know that the quality of life is at least middle class or slightly upper middle class, depending on where you are. In the Midwest, that number carries a lot more weight than it does in California or New York.
Yeah.
If you're in one of the more expensive states, that number is probably 150 to 175,000.
Right. Yeah, and the not so expensive states, you're in the 20s and 30s. 20,000.
Absolutely.
Yeah. All right. Last question, Dennis. I could go on for hours here, but I'm going to give you one last question here. If you could go back 15 years and you could set beside somebody who was on a similar path as you were at that time, focused on the same things in what you were doing professionally, focus on the same things, what you wanted to do personally with your family, knowing the things that you know now, the experience that you have now, and you could go back 15 years and you could set beside that person who may have been on the same path as you, what would you tell that person?
So it's interesting because that would be 2009 for me. So that would be a tough time. So that's one of the reasons that I probably delayed becoming an entrepreneur, because the PTSD of the financial harm that I experienced during that. But I will tell you, in general, my advice to anybody, if they think they're ready to take that step, is go for it. Because ultimately you have the ability to go back to whatever you were doing if it doesn't work out. And I think that took me a decade too long to figure that out, is to have enough conviction and confidence in myself. I had that, but it was the what if I failed. And I had such a worst case scenario in my mind that was kind of detached from reality because of what happened during the recession. And so I have a lot of friends now that are stepping out on their own. I'm like, look, man, give yourself 2 years and go at it 100%. And if you don't like where you're at, go back to what you were doing. At least you can sleep at night knowing you tried and it didn't work out versus the what if. Because the what if is the most haunting thing ever. And that's something I deal with today, even as things have gone very well for me over the last 5 years, is what does this look like if I just had the stones to go do it in 2010 versus 2018. So that is definitely what I would tell people, is it doesn't even matter what the strategies change all the time, opportunities change all the time, but having the courage to go after what you're really passionate about or taking that next leap as an entrepreneur, I think that that is important regardless of what time you're entering the market. That's it for sure. So go for it, everybody.
Yeah, that is awesome advice. Take the leap. And, worst case scenario, like you're saying, you could always go back to what you were doing before, and then you would have that knowledge, that experience to build from. There's just so much. And that regret piece is huge. Like, not because you can't ever just go back right after and say, oh, I wish I would have done this. And it's harmful too, to even for you to think about that, Dennis. What if I could, went back to stop that? Just, if I could encourage you something, just stop that, because
there are so many situations that just come to my mind immediately where I had the tiger by the tail and I just didn't do it. Instead, I handed it to a company and said, let me do this for you.
Right.
They weren't even adding any value. They just were providing me a safety net. And, sometimes you just got to take that leap. So I would say the only other factor in that is, business plans and strategies are going to change over time. But just if you are going to start doing something on your own, you should know what it is you're doing. So you're not trying to do 9 different things at once. At least find one thing to begin with that you're going to try. That may evolve and change over time, but at least have that one thing you can stay focused on once you do take the leap.
Yeah, that's awesome. Great advice. And man, your experience, knowledge, willingness to share, I just filled with gratitude, man. It's been an awesome conversation. Pleasure chatting with you here. And thank you for your time, Dennis.
Thanks, man. Really appreciate it. I had a great time.
Absolutely. And I just want to say one more time, it's sentinelnetlease.com, where the listeners can go learn more about your experience, your journey, your team. It's SentinelNetlease. Sometimes it's spelled different than it sounds, but that one's it, Sentinel Net Lease. And that fund that you were talking about, you've got that opened up too. That's sentinelopfund.com. OPP.
That's right.
Right? Are you down with OPP? Does anybody ever recall that song? Those are my jokes my dad jokes that I get to lay in this time of my life. But it's the Op Fund, sentinelopfund.com.
Yeah, that's right. Thanks so much, Brad. Really appreciate joining you today. It was a lot of fun.
Yeah, it's fun, man. We're going to let you get back into the Mexico time there. And for the listeners here today, thank you for your attention. That attention to me is always more important than the time, because I can think back on all these things that, like Dennis was saying, through the years. And man, if I would just given my attention, I'd given something my time, but it didn't get my full attention. And we appreciate your full attention here today, talking with us, learning more about commercial real estate, some of the residential type things. And if you have any questions for us, you can send us an email, info@physicianwealthsystems.com. And until next time, thank you so much again. This is the Real Estate Mogul MD.